Okay, everyone, now we're ready to start into chapter 1. Hopefully you listened to the prologue to learn some of the background of managerial accounting. So now we can get into what the skills and different items are that you need to be familiar with. In learning objective 1, we're going to understand cost classifications used for assigning cost to cost objects, direct and indirect costs. So some of these items you may be familiar with, but we just want to bring them to your attention. And those of you who've never heard of them before, you'll learn about them. First of all, a cost object. What is it? It's just something we want to determine the cost for. It could be our products. It could be our customers, a job that's being completed, a department. So anything we want to find the cost for. Now, our costs could be broken down between direct and indirect. So you'll hear these terms used a lot throughout the semester. Direct costs are costs that can be easily and conveniently traced to a unit of product or other cost object. So if you're thinking of a product, it's the direct materials. What's that? Direct materials would be, let's say you're making a plastic water bottle. It would be the plastic used. It would be the person making the water bottle. Direct materials, direct labor. So the cost of that person to make that water bottle. Indirect costs are costs that can not be easily and conveniently traced to a particular unit. And we usually call that manufacturing overhead. What are we talking about here? The electricity for the warehouse where that water bottle is being made or manufacturing facility. The electricity, the rent for the warehouse or facility that that water bottle is being made. The salary of the manager of the production line. So these are all necessary costs to make the water bottle, but they're not, you can't say this much is associated with that water bottle precisely, because it's not, there's more than, with the electricity, for instance, you're making more than one water bottle. But for a particular water bottle, you could say I use this much plastic and spent this much time. So that's why they're direct costs. In learning objective 2, identify and give examples of each of the 3 basic types of costs when you're manufacturing or making that water bottle. Here we're making, looks like a Corvette or something, direct materials, direct labor, and manufacturing overhead. Again, the raw materials that become an integral part of the product and that can be conveniently traced. So it's easy to trace those items. The radio installed in an automobile, the amount of plastic used for one water bottle. Direct labor, the cost that can be easily traced to an individual unit of product. I gave you the example before of the time a person spent in making that water bottle. Wages paid to the auto assembly worker making the car. It can be directly traced and pretty easily. Manufacturing overhead are all those other costs that are needed to make the product but cannot be easily traced to that specific product. Indirect materials and indirect labor. I mentioned some of these before. So these are materials used to support the production process, indirect materials. The lubricants and cleaning supplies used in the automobile assembly plant. So you need them. They're materials used, but they're not just for that car. Wages paid to employees who are not directly involved in the production work, like the maintenance workers, janitors, the security guards, the managers. So those are the costs associated with the product, the manufacturing costs. Then we have non-manufacturing costs that could be associated with the product but are not necessary to make the product. Selling costs. These are costs to secure the order and delivery of the product. They can be either direct or indirect, like advertising, sales commissions, the delivery truck to deliver the product. The other types of non-manufacturing costs are administrative. And sometimes companies call them the necessary evils, right? Because they're not directly selling any product, but they're more of an indirect cost. They're all the executives, organizational and clerical costs. So these can be either direct or indirect as well. So what kind of costs are used to prepare our financial statements? Product costs and period costs. Now you have to think back to financial accounting a little bit here. So we're going to talk about that. The T account. Now, when it comes to product costs are your direct materials, your direct labor, and your manufacturing overhead. And in cost accounting, we really go into detail on how to journalize those items. We're going to be using these in managerial accounting. We just want to introduce you to them now and make sure you understand the difference between these two types of costs. So product costs ultimately end up as an asset in inventory. When they are sold, those particular products, they are then transferred to an account called cost of goods sold, which is an expense. So product costs initially are an asset because you made an asset. And then when it's sold, it becomes an expense. Period costs, those selling and administrative costs, are always an expense because they're costs of that period, non-manufacturing. They are not product costs. So let's do a quick check. Which of the following costs would be considered a period rather than a product cost? Take a look. And your answer is B and D. The manufacturing equipment depreciation is necessary to produce the product. That's a manufacturing overhead. Direct material costs, definitely product costs. And then electrical costs to light the production facility, definitely a product cost, overhead. The other two, sales commission and property taxes, are period costs. Now, we could further break our costs down into two more categories. In the manufacturing process, we'll have what's called prime costs and conversion costs. So you want to be familiar with these. Prime costs are your direct materials plus your direct labor. Conversion costs are your direct labor plus your manufacturing overhead. In Learning Objective 4, we're going to understand cost classifications used to predict cost behavior, specifically variable costs, fixed costs, and mixed costs. So what is cost behavior? Well, it refers to how a cost will react to changes in the level of activity. So the most common classifications of costs to help us do this prediction are variable, fixed, and mixed. So what kind of costs do we have? A variable cost will increase as the amount of product increases, and it increases in the same proportion. So your total texting bill may be based on how many texts you send. So the more texts you send, the higher your bill. The more product you make, the higher your variable costs. Variable cost per unit is constant in the respect that it will be the same amount for each product. So the cost per text sent may be constant at 5 cents per text message. So what we're saying here is that each text will increase your cost 5 cents. If you have no text, you don't have any costs. But as you start texting, your variable costs will overall increase, not per unit, but on a total basis. So the understanding here is that if you have 0 text, you have 0 costs. If you have 10 techs, 10 times 5 cents, you'll have 50 cents in costs. If you have 100 techs, 100 times 5 cents, you'll have a $5 cost. When we have an activity, it's called an activity-based or a cost driver. And what it is, it's a measure of what causes the incurrence of a variable cost. So why does that variable cost happen? It could be machine hours. So we could measure variable costs on machine hours. Labor hours is another example of a variable cost, meaning the more someone works on a product, the overall total variable cost will increase. Miles driven, units produced. So there's various ways of measuring a variable cost. Fixed cost is different. Fixed cost remains constant whether you produce 0 techs or 100 techs, and it's always the same dollar amount. It doesn't increase as your techs increase overall. So it's a cost that remains constant in total regardless of changes in the level of your activity. So for instance, your monthly contract fee for your cell phone may be fixed. Rent on a building, fixed. So whether you produce something in the building or not, you still got to pay the rent. That's what we're talking about here. If expressed on a per unit basis, the average fixed cost per unit varies inversely with changes in activity. What does this mean? Well, if you have 0 usage of a building, you're going to have the highest fixed cost. But as you produce more and more of a product, the fixed cost per unit will go down. For instance, you have to pay $1,000 a month for your rent. You don't produce anything. Well, you produce 1 unit. What's your fixed cost for that unit? $1,000. What if instead you produced 100 units? Well, how much is your fixed cost per unit now? 1,000 divided by 100, or $10. So that slope, that graph depicts showing you the more you produce, the lower the fixed cost per unit. Types of fixed costs. There's committed ones. They're long-term, cannot be significantly reduced in the short run. Depreciation on your building equipment, real estate taxes, maybe even rental agreements. Discretionary fixed costs can be altered in the short term, maybe in advertising, research and development. The relevant range of activity pertains to fixed costs as well as variable costs. So for example, assume office space is available at a rental rate of $30,000 per year in increments of 1,000 square feet. Fixed costs would increase in a step fashion at a rate of $30,000 for each additional 1,000 square feet. Take a look. That is what a graph of it would look like. So the first 1,000, you would have 30,000. Then the next range. Okay, so we're showing you the amount of square feet, but that's the relevant range that increase would occur at. And the cost remains flat until you get to that next range. So again, we classify the costs so that we could predict the cost behavior as activity changes. So variable. Total variable cost increases and decreases in proportion to changes in the activity level. Variable cost per unit remains constant, but overall variable cost will increase if production increases or decrease if production decreases. Fixed cost isn't affected by how the activity level changes overall in total. You got to pay $1,000 a month for rent. It doesn't matter if you produce 0 or 1,000 units, you still got to pay 1,000. But per unit, fixed cost decreases as the activity level rises, and it increases as the activity level falls. As I said before, if you produce 1 unit and you have $1,000 month per unit, your fixed cost for rent is $1,000. But if you produce 100 units, you now have reduced the fixed cost per unit to $10 per unit. And you need to understand that and remember that, because when you're predicting costs, you have to know what happens. So which of the following costs would be variable with respect to the number of cones sold at Baskin and Robbins shops? The cost of lighting the store, the wage of the store manager, the cost of ice cream, the cost of napkins for customers. C, because the cost of the ice cream will predict, and also the cost of napkins for customers would predict how well or how much they sell. And the variable cost will change as the number of ice cream cones change. The next kind is a mixed. It's variable and fixed together. So a mixed cost is both variable and fixed. It has both of those elements. Take a look at the example of utility cost. If your utility bill has a fixed monthly charge, kind of like your cell phone, you have a fixed monthly charge. No matter how much you use it, to a certain point, it remains constant. Okay, or maybe there's a fixed fee on it, even if you want to look at it that way, just to have the product or the service here. In this case, you have to pay $100 a month. On top of that, you pay for your usage. So the more you use your electricity, the higher the cost will be. That's what we're talking about here. So some of it's fixed, some of it's variable. So the total mixed cost can be expressed as an equation. Y, which is the total mixed cost, equals the total fixed cost A plus B, the variable cost per unit, times X, the level of activity. And if you think about that, fixed cost, that always will be there, plus the amount of activity times the variable portion. That's your total mixed cost. Example, if your fixed monthly utility charge is $40, your variable cost per kilowatt hour is 30 cents, and you used 2,000 kilowatts, your utility bill would be 40 plus 3 cents times 2,000, or 100. As your activity increases, your bill will go up. As your activity decreases, it will go down from that point. Uh-oh. So let's take a look at account analysis and the engineering approach, which is an analysis of mixed cost. In this account analysis, each account is classified as either being variable or fixed based on what the analyst knows about the account. The engineering approach classifies costs based upon an industrial engineer's evaluation of production methods, material, labor, and overhead requirements. So they're just two different approaches to analyzing mixed costs. So analyze a mixed cost using a scatter graph plot and the high-low method. So how do we analyze mixed costs? Well, we could use different methods. A scatter graph, here's an example. Assume the following hours of maintenance work and the total maintenance cost for 6 months are as follows. So you can see the information there. And I believe this is in your book as well. Yeah, it's on page, no, that was not the one. It's a little different there. The numbers are just a little, yeah, those are for patients, sorry. I thought it was in your book, but there is another example in your book, so that's even better. But this is for hours of maintenance work and total maintenance costs for 6 months. So we plot all those points on a graph where Y is the dependent variable, the total maintenance cost, and X is the independent variable. So as the hours of maintenance changes, the total cost, which is dependent on the hours of maintenance, will change over as well. And we scatter these or graph these so we could try to find a straight line, and that will help us predict the behavior of the mixed cost. So that's one method. The other method is the high-low method. So the variable cost per hour of maintenance is equal to the change in cost divided by the change in hours. So if you take a look, we take the high number, the highest cost of maintenance, and subtract the lowest cost of maintenance, which would be 2,400. We do the same with the hours of maintenance in that same, or with the, which will be in that same area. So the total cost, the low would be because of 450 hours. The high of 98 is because of 850 hours. Take the difference there. We then divide the 2,400, the difference between the high and the low costs, by the difference in the high and the low hours of 400. So the variable cost per hour would be $6 per hour. So the total fixed costs would be total costs minus total variable costs. So if the total cost is $9,800 and the variable portion is $6 an hour, multiply that by 850 hours, the total variable cost then would be $5,100. The fixed cost portion of that mixed cost item is $4,700. So it's just a way of determining in a mixed cost scenario how much is fixed, how much is variable. So you can do and predict your cost behaviors as they change. So the cost equation for maintenance, when you want to find the total mixed cost item, would be the fixed portion plus the variable portion times the amount of production, or in this case, maintenance hours. That would help you break your mixed cost down between fixed and variable so you can determine total cost when behavior changes. So sales, salaries, and commissions are $10,000 when 80,000 units are sold and $14,000 when 120,000 units are sold. Using the high-low method, what is the variable portion of sales, salaries, and commission? So that is an example of a mixed item. Well, it would be 10 cents. $4,000 difference divided by the 40,000 units, 10 cents. Sales, salaries, and commissions are 10 and 80, when, etc. What's the fixed portion? Take your total cost of 14,000. That equals your fixed cost plus 10 cents. How many units are being sold when the total cost is 14,000? 120. So 12,000 of the cost is variable, 2,000 is fixed. Another method for analyzing mixed costs is something called regression analysis. A scatter graph plot reveals an approximate linear relationship between X and Y. So you could basically draw a straight line. then you can use this method. And it's a method very easily used in Excel because what you do is you use all of the data points to estimate the fixed and variable cost components of a mixed cost. The goal of this method is to fit a straight line to the data that minimizes the sum of the squared errors. And like I said, software is usually used to fit a regression line through the data points. And the cost analysis objective is the same, y equals a plus bx. So you would present the data that you have, for instance, how many hours in total costs for your maintenance people, into a software program and compute the least square. And that will produce what's called R2, which is a measure of the goodness of a fit of the regression line. So it's telling you how well your data can be used on a graph and how well it forms a straight line so that you can keep extending that straight line to get good data about your mixed costs. So which method should you use? Well, the two methods just discussed provide different estimates of the fixed and variable cost components of a mixed cost. This is to be expected. It's two different methods. So least square regression, though, provides the most accurate estimate because it uses all of the data points. High-low is just taking the difference between your highest and your lowest. It's more of an estimate, where regression, you're using every single data point, putting that information into software that will give you information back on how well you can use this to determine cost changes because of a straight line. Just different methods. You don't have to do a least square. We just want to make you aware that is out there. Not at this point anyway. Now, the final, I think this is one of our final objectives, is prepare income statements for a merchandising company using the traditional and contribution formats. Let's take a look. Remember, on a traditional format, this is what we learned back in financial accounting. Sales minus cost of goods sold gives you gross margin or profit. You subtract your selling and administrative expenses and you get your net operating income. On a contribution format, the managerial approach, we take sales minus the variable expenses, those that change as production changes or sales change. That gives us our contribution margin. Then we subtract our fixed expenses, those that don't change based on production, to get our net operating income. So that's what management accountants are using. The contribution income statement format is used only as an internal tool in decision making. So we'll be seeing this again in chapters 5, 7, 6, and 10. So that's why we're introducing it to you in chapter 1. And that's all chapter 1 is, an introduction to some vocabulary and information so you're familiar with it. So when we get into different approaches, you'll already know what those terms mean. We're going to understand cost classifications used in making decisions: differential cost, opportunity costs, and sunk costs. Every decision involves a choice between at least two alternatives. It's just the way our life is. We have scarce resources and unlimited wants, right? All those costs and benefits that differ between alternatives are relevant in a decision. All other costs and benefits can and should be ignored as irrelevant. Example, costs and revenues that differ among alternatives. You have a job paying $1,500 a month. You have a job offer in a neighboring city that pays $2,000 a month. The commuting cost to the city is $300 per month. So the differential revenue here is $500. The differential cost is $300. So you'll increase your revenue by $500, but also increase your cost by $300, the extra, the difference among alternatives. An opportunity cost is a potential benefit that is given up because you selected one choice over the other. So these costs are not usually entered into the accounting records, but must be explicitly considered in making decisions. So what are the opportunity costs you incur to attend this class? So another way of looking at this, if you can't really wrap your head around it, you have $10. You can buy 2 bags of popcorn or a hot dog and a soda. So what did you give up when you bought that hot dog and the soda? 2 bags of popcorn. That's the opportunity cost. Some costs have already been incurred and cannot be changed now or in the future, and they're ignored. So suppose you had purchased gold for $1,100 an ounce, but it is now selling for $950. Should you wait for the gold to reach $1,100 an ounce before selling it? You may say yes, even though you already bought it, it's over with, it's done, it's a sunk cost. It's already occurred, you can't change it. Suppose you are trying to decide whether to drive or take the train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the cost of the train ticket relevant in this decision? In other words, should the cost of the train ticket affect the decision of whether you drive or take the train to Portland? Yes, it's relevant. So you have to look at how much does it cost to drive, how much is the train ticket? Differential. Suppose you're trying to decide whether to drive or to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the annual cost of licensing your car relevant in this decision? No, because you're going to use it for more than going to the concert. That's a sunk cost. Suppose your car could be sold now for $5,000. Is this a sunk cost? No, it is not a sunk cost. You could sell it for $5,000. What you paid for it is. So in this chapter, we looked at and introduced you to a lot of vocabulary used in managerial accounting, specifically looking at the different types of costs, whether they be direct or indirect, manufacturing costs, product costs versus period costs, variable, fixed, and mixed costs, just different terms to describe costs. We looked at preparing an income statement traditionally in that financial sense, and now in our contribution format where managerial accountants focus, and then differential, opportunity, and sunk costs. So go ahead and work on your exercises. I'm going to be getting a practice problem up there for you to review as well with the voice. And if you have any questions, post them to the discussion board.